It's 9 a.m. in Beijing and Hong Kong. Welcome to Bloomberg Markets China Open. I'm Annabelle Droulers with Yvonne.
Our top stories this morning: Asian stocks rise, fueled by a global equity rally as the AI craze sparked by NVIDIA. Bullish outlook there, sweeping markets once again. China's securities regulator, though, denying restricting stock sales, saying its recent measures were meant to curb abnormal trading. Plus, the Bloomberg scoop: the U.S. and China discussing new measures to prevent a wave of EM sovereign defaults, potentially their biggest joint economic project in years. So that's one stock in that scoop that we're tracking, of course. But then again, you got to talk about it's all about the equity market at this point. You take a look at the U.S. It's the Nasdaq, it's the S&P, it's the Dow reaching records, it's Europe, it's Japan, all reaching those all-time highs. And really, it comes down to one stock, NVIDIA, lifting this market. And certainly, we're seeing some momentum in the CSI 300 as well.
I think you want to put it in perspective, because let's just talk about NVIDIA, I think, for a moment itself. I mean, it was a 16% jump intraday, but you're also talking about $277 billion in market cap being added in a single session.
It's a record.
It's absolutely, it's just incredible numbers. And as some analysts are saying, this is a company that's pretty much printing money at this point in time. And so yesterday we actually already saw those chip makers rising in the session, given we had those earnings coming out after the bell. So this is the day two reaction we've actually got for Asia today. And you're continuing to see that climb here coming through. These are the Taiwanese chip makers. Taiwan market's just coming online. But it is broad-based. If you change on now, take a look. Japan's shut today for a public holiday, we should note. That's why we're checking the MXAP ex-Japan there at the bottom of the screen. But again, chip makers, it's still the focus here. You've got the likes of SK Hynix, for instance, gaining nearly 3% in the session. And tech stocks generally. Singapore to note, because again, has just come online. A little bit of weakness coming through. Let's change on, because it's not just NVIDIA. We're also focusing on what Fed officials are saying this morning. And again, a lot of them speaking. Waller's the latest one. But there's just a really one key word coming out of it, and that's patience. They're really saying you've got to hold your horses, wait. Rate cuts, yes, they're coming, but they're not coming perhaps as soon as what markets had been anticipating earlier this year. And again, the market reaction pretty subdued off the back of that. We've already seen a lot of repricing around expectations over the past few weeks. China stocks, let's take a look at how futures are performing so far in the session. It has been that general climb over the course of this week. We are setting up for a little bit of weakness, though, today. And I think really, again, okay, keywords, NVIDIA, you've got patience. And then I think Quanquake would be the one we're watching for China today. Yeah,
this is something that continues to boil, I guess. And we're hearing more statements from the CSRC about what exactly that they're doing across these markets to stabilize things. It's not quite stopping people from buying and selling stocks and limiting sales, according to our reporting. But that certainly is going to be a key discussion throughout the shows here. So that's when we're watching. Is this really likening to the 2007 Quanquake that we saw back in the U.S.? China new home prices coming up at the bottom of this hour. Continuing on this whole AI trend here. We had some auto passenger sales come out here, which were a bit gloomy in terms of how durable goods, how car sales are doing here. So we're watching those auto stocks very closely. U.S.-China ties, everything from what we talked about, helping out to prevent defaults across the world. That's good. There was some cybersecurity issues. And then we have panda diplomacy, which we got to talk about. Stand-chart earnings coming up a little bit later on. Macau visitor arrivals to wrap up your day. But certainly it is still this rally we've seen 8 days on the CSI 300, the longest winning streak since 2020. That certainly means there is still some buying going on here. And still, the one game in town, it's NVIDIA. It is still staying in overdrive, as Bell had mentioned here. The amount of market cap added in one day is a record, and it is basically what is driving really all these major U.S. benchmarks, right? You take a look at where the S&P and all that is looking at. But it's really this, I think it's 50-something% that it's gained in 2 months. This stock alone is just incredible. So, is this really the most important stock in the world? Well, let's get back to our top story first.
No, but NVIDIA, of course, will be discussing it later in the hour. But yes, our top story, China's securities regulator says it's put in place measures to regulate abnormal trading, but they deny that they're interfering with normal market transactions. Let's bring in Bloomberg's Asia Stocks Managing Director Lian Ting Tu and our Bloomberg opinion columnist Shuli Ren. And yeah, let's just kick off with what we heard again yesterday, that pushback a little bit from the regulator there, saying that they're not really interfering, but still they are sort of getting involved to some degree, it appears. Lian Ting, what was your take on it?
Yeah, I think the regulator wants to make sure that the global audience or global investors will take it as still sort of promoting market friendly or free market approach to regulating the Chinese stock market. But in reality, because of the heavy-handed intervention in this quant market in the recent weeks, a lot of quant funds actually are really afraid, and more punishment or curbs will be imposed by the CSRC, and then they are really not conducting their business as usual, which means they would typically sell at the open, maybe wait for the national team to come in and buy back, that sort of trading strategy. So yes, the rhetoric is out there that the CSRC is only wanting to regulate normal trading, but in reality, I think we at CSRC stick sort of policy really disciplined quite a few quants in the mainland market.
And Julie, I think one of the managers that we've been talking to is that this is seen as one of the industry's biggest black swan events. Do you subscribe to that view?
Not quite black swan, but it was a blow to the masters of the universe, so to speak. What happens is that these quant funds last year did quite well, and they did a lot of the so-called index plus, index enhancement portfolios, basically picking small stocks off of China's universe of 5,000 stocks, right? And then this year, suddenly, a lot of them are nursing like double-digit losses in just 2 weeks. And in that sense, they're comparing that to the 2007, the summer of 2007 in the U.S., when a bunch of very high-profile and successful quant funds, including from Goldman Sachs, nursed very, very big losses. So that's the comparison right now.
And Liang Ting, of course, I think the industry's fate here really depends just exactly on how regulators are going to continue responding. We know that the next raft of regulations are going to be sort of rolled out one by one, but is there any sort of context beyond that?
Yeah, right now we don't know. Our reporters have been, asking around what kind of policies are we expecting out of the regulators. But so far, I think the chatter is the regulator actually wants to follow through with this sort of, a rhetoric that they only wanted to regulate normal trading, and the chatter is they may actually lift that ban from the ban which they put on mutual funds from selling at the open and the close. So if that's really true, that means the regulator would probably just follow through with what they set out to do, which is just to discipline the abnormal behavior, not to really restrict stock selling in the market.
And Liang Ting, I mean, what do we make of Wu Qing, this new CSRC regulator now? It seems like his approach to these markets are quite different from what we've seen from people in that post before. I mean, is this something that investors are liking here right now? I mean, what's the overall take that you get?
Yeah, so far, I think the reaction has been positive. Wu Qing, of course, had the reputation of being the butcher of brokers, and how he was a bit more heavy-handed than his predecessor. And we have reported that Wu Qing has actually invited quite a few financial market experts and showed willingness to really listen to their criticism and try to do something to curb the market declines. And the latest, I think, is that he wants to really restrict IPO approvals, which is really a 180-degree sort of turn from the predecessor, who actually wants to, make the IPO approval process more sort of just, self-led and registration-based. But I think right now, because of the pessimism in the market, this kind of heavy-handed regulation is what investors actually wanted. But in the longer term, whether this is really healthy for the market is quite debatable.
Heavy-handed regulation surely is something as well that's sort of kept international or US hedge funds out of the market. Is that something that you think has as well exacerbated these issues?
I absolutely think so. I mean, like whenever China has a stock market rout, let's face it, they like to blame the quants and algorithmic trading, right? Like we saw that in 2015, they actually berated the Citadel, which the hedge fund, in the end, they paid almost $100 million in fines. But I think China has been talking about opening up its financial markets for many, many years. We have been all covering this, right? But the pace is very, very slow. And as a result, its own domestic asset management industry is just very green, inexperienced, immature, kind of like it's a chip industry, let's face it. So I think this quant quick, a lot of it is just because the quant funds are really bad. They don't know what they're doing. They don't really understand risk management. And if China, say, allowed Citadel or Millennium come in to its domestic market, say 5 or 7 years ago, its domestic quant funds probably will get a little bit better. Or if they're not good enough, they will have exited already. So I think this is an issue that could have been avoided. But again, we don't know whether the Chinese government is learning the right lesson.
Yeah, spell out for us what this means then, right? Are we expecting more waves of redemptions among these quant funds? Or do you think, they can actually change up their strategies in a way to adapt to this new environment and these new rules?
I think more redemptions is inevitable. I mean, Chinese investors, they look at returns and say, what happened? Last year you earned 7%. This year you're losing 15%. They are going to redeem further. Even as they change their style and try to be more adaptable, I think this subsegment of the industry is going to have a little bit of a setback.
All right, Julie, great stuff. Julie Ren, our Bloomberg Opinion columnist. Also, our thanks to Lanting, too, our Asia Stocks Managing Director, joining us out of Singapore. We're coming down to the open of trade in Shanghai, Shenzhen, and Hong Kong. We'll see if we get that 9th straight day of gains when it comes to that CSI 300. We are down in terms of futures about 0.5%. This is Bloomberg Markets China Open. Happy Friday.
What a sensational set of results from NVIDIA.
This is really the earnings heard around the world.
I'll do my best to sort of contain my enthusiasm.
It seems each quarter they continue to surprise.
There are going to be significant benefits.
The only result that was going to be acceptable was not only a beat, but a substantial beat.
This is a company that continues to execute and completely blow away everybody's most robust forecast.
You can't deny the impact that it's having across not just in the US market and the US tech sector, but actually globally. And I think one of those reasons is that people are really buying into this idea that it isn't a tipping point.
There is great momentum there.
People are beginning to wonder how many consecutive quarters can this company continue to run with.
The big question has been, how long can this continue?
There is sort of a consensus in the industry to put some competitive pressure back on NVIDIA.
The competition has never been more fierce than it is right now for NVIDIA, but they have a huge head start.
This tidal wave of spend, it's coming to the rest of tech. And in our opinion, that's going to continue to fuel this tech bull market.
The equity market's sort of really nicely sort of set up from here.
This AI party, it's just getting started.
That was some of our guests there reacting to NVIDIA's blockbuster rally. And I mean, the market reaction to those numbers has been absolutely exceptional. Up 16% in one day. You're adding about $277 billion in market cap. And that is the biggest single day surge we have seen for a company ever. And it's really putting NVIDIA as well, getting a lot closer now to entering that $2 trillion club. The market reaction, of course, not just limited to tech stocks. We saw rallies in the S&P 500, the NASDAQ, now Dow Jones, European stocks. We've got the Japanese index. All of these are hitting all-time highs. But let's get more on these numbers now. Bring in Gary Evans, Chief Strategist for Global Asset Allocation at BCA Research. And Gary, I want you to just kick off by maybe bringing us down to earth a little bit here, because how much longer can we see this sort of rally here? Is NVIDIA really a stock we want to be buying at this point in time?
Yeah, but I loved hearing all those gung-ho fund managers there. I mean, look, let's be honest, they were good results. NVIDIA has got a monopoly of chips that go to large language learning models. But a couple of problems. So number one, when I learned finance, I was always told that if there's a company making supernormal profits, unless it's got some competitive moats, people are going to come in and compete those supernormal profits away. If you look at the numbers, NVIDIA sells almost half of its chips to only 3 companies. And we can guess who those are. they are going to try and find other people to source those from or produce them themselves. And what NVIDIA does, it doesn't produce the chips. That's TSMC who does that. They just design them. And they're ahead of that. But how long is it before Samsung, before others catch up with that? The second problem I would say is, yes, AI is exciting. I like to think of myself as a sort of tech nerd. I've been using quite a lot of AI applications. But is it really changing the world? Have we yet found that killer app that's going to change things? Now, even the internet, if you think about it, when that came in, that changed the way that we worked. But you can't see the impact of that in the productivity data at all. The last time we had a real big change was when PCs came in. We suddenly went from writing things by hand or typing them to having a computer on our desk. I don't think at the moment it's clear that there's a killer app for artificial intelligence which justifies the sort of valuations that you've got out there.
So how long do you think this global equity rally can last, right? Because the first 2 months of this year, I mean, equities have certainly been the winner if you compare to what bonds have been doing, because bonds have basically caved to a lot of that Fed repricing already.
Yeah. So, well, when you say that, equities outside of the magnificent 7 or 6 or probably 5 these days actually haven't done that well. I mean, we've seen a few attempts by other parts of the stock market, like small caps, to rally and then have failed. If you look at smaller tech companies, Cathie Wood's ARK Innovation, for example, that ETF is down, I think, something like close to 10% this year. So it's limited to a very few number of stocks. But your question is, how long can it go on? The timing, that is really hard. The problem with bubbles is that they always last longer than you think. And I would deliberately use that word bubble. It's getting to me to look pretty similar to 1999. And what happens with a bubble is there is a genuine change. That was when we first started using Google, for example, to do internet searches. We saw the number of internet users doubling every year, 98, 99, but that came down with a crash. But how long did it keep going for? It kept going probably for longer than certainly people like me thought at the time. So yes, this can go a bit further. AI is a genuine change, but I wouldn't buy NVIDIA at these sort of valuations.
So Gary, what's the pinprick here? I mean, what makes the bubble burst?
Yeah, so, it can be the next quarter's earnings. I mean, can NVIDIA keep on blowing out the lights every quarter? I mean, its guidance for Q1 is actually relatively cautious. The amount of additional sales is quite low. It could be equity issuance. They decide they need to issue some more shares. That was one of the things that burst the bubble in February 2000. It could be the Fed. I mean, at the moment, we're all ignoring the Fed. We've had all these speakers today that you've been talking about, making it very clear the Fed's going to be patient. They're not going to cut rates quickly. Maybe we start to get a hint, as we've seen, for example, from Australia and New Zealand. Well, maybe we might need to raise rates once more, because if the next PCE inflation data in the US, I think it must be next week, is a bit of an upside surprise, which is likely, and the economy keeps on going gangbusters as it is, well, maybe inflation risks are going to reemerge. So that could be the thing that bursts this bubble, perhaps.
I'm just wondering, in terms of the U.S. data, it continues to be strong. You're not hearing a whole lot of people talking about recession concerns anymore. In fact, you have some fund managers saying, I'm dumping my treasuries holdings now because of just how resilient this economy is. Do you think that Goldilocks narrative is still intact? I know you're still kind of being overweight on fixed income. In what form?
Yeah, so that's clearly the consensus, is soft landing. But I mean, the pushback I would give to what you just said is, yes, the US looks fine, but look at the rest of the world. And we had the PMIs out yesterday in Europe, in Japan, particularly for manufacturing, still look really weak. And last week we had GDP data in Japan, in Germany, in the UK. They're all in recessions, those economies. So it's really only the US that's looking resilient. Now, it is holding up, but the key issue here is, how long does tight monetary policy take to work through to the economy? The Fed raised rates by 525 basis points in 18 months or 15 months. And we're starting to see a few signs that is going to hurt. It's hurting the housing market. It's clearly hurting commercial real estate, et cetera. So, ultimately, that's what it comes down to at the moment. But also, I think at some point the Fed starts to worry about, well, if the economy really is looking this resilient, doesn't that mean that wage growth is going to stay strong? Doesn't that mean that inflation is going to pick up? And therefore, the market has completely shrugged off the repricing of the Fed's action in the last 6 to 8 weeks. I don't think it can continue to shrug that off forever.
Given the high price tag that are on US stocks, for instance, other markets as well, is now the time to perhaps be considering cheaper markets like China instead?
As a trade, yes, I think that's right. And quite a few clients I speak to for the last month have been saying, well, China surely in the short term has got to have a rebound. Typically last year's loser has a bit of a rebound in the first few months of the year. The Chinese authorities can't live with the stock market as weak as this, but it really is only a trading rebound, I think. I mean, at the moment, the Chinese economy still looks very weak. We'll get the housing numbers out any day, any minute now. I think the problem with those is they don't really reflect reality. What I'm hearing from people in China is that actually transactions are being done 20, 30% below the market price. The government's very reluctant to cut short-term interest rates, the PBOC is, because it knows that would weaken the currency. For the moment, that's not a priority. So, and we've also got an economy and a government that is very unfriendly towards a private sector, towards foreign investors in general. And I think there's a lot of clients I talk to generally would say now that China is uninvestable. Doesn't mean it's not tradable for a quick bounce. We've had quite a 10% plus bounce already. I think the A shares in particular, the Chinese government doesn't want individuals in China to lose out. But I wouldn't buy the H shares. The government's not going to focus on those.
Gary, great to have you. Thanks for joining us. Gary Evans there, Chief Strategist for Global Asset Allocation at BCA Research. Just want to check when it comes to that renminbi fix just crossing your Bloomberg here right now. So it's once again pretty solid at 7.1064. So you're still seeing that policy support. The offshore renminbi, though, has been strong of late. I think we've gained for about 6 sessions, but we are still, of course, trading near the weaker side of that trading band here at 720.29. Futures are still pointing a little bit negative here today. Hang Seng is lower by 0.5% in the pre-market. We'll see if we get another day in this rally. CGB is not going anywhere at 240 for your 10-year. Plenty more ahead. This is Bloomberg. All right, your futures are looking like this here this morning. Looks like we could be, we'll see. I mean, it's been a good week when it comes to Chinese equities. So is this really momentum that we're seeing here? Is there actual signs of real money coming back? That's still the key question. We're still lower in terms of futures this morning. We're seeing the Chinese 10-year yield that's just below that 240 level here. When you take a look at what this rally has looked like, though, right? We're talking about at 8 days of gains for onshore stocks in CSI 300. We haven't seen a rally like that since 2020. So it seems to be that there is maybe some support here. Well, CSRC certainly is one thing. All these sort of new rules when it comes to trading is certainly one thing that has been quite supportive for this market. In terms of analyst actions we're tracking for you today, Lenovo cut to accumulate at CLSA. You have the auto stocks very much in focus as well. BAIC Motor 8 shares raised to overweight at JP Morgan. Ganfeng Lithium, those 8 shares also been raised at Citi here. They're talking about a 30-day catalyst watch here, given the A shares, potential demand uptick and stabilizing Sudamin prices, if I'm saying that right. The open is next. This is Bloomberg.
You're watching Bloomberg Markets. China open, counting down to the start of trading in Hong Kong, mainland China. The start of the day here pointing to a little bit of weakness across the board. We actually have seen that run up over the course of this week, but starting to perhaps dissipate so far, that investor interest. What else we're tracking is those property prices. We've got that data due in just about 30 seconds. Yvonne.
Yeah, if we're going to see any signs of this downward downturn in the market turn in any way, I mean, we're certainly looking for those signs of that. We haven't seen that yet in the data, so certainly that is the one to watch here in terms of data prints in the next couple of seconds or so. Your market is looking like this here right now, so we are actually still capping the best winning run for the CSI 300 in 4 years. So certainly there is some buying taking place here across this market. Futures and the pre-market in Hong Kong is looking like this here right now, but we'll see how this all plays out after what we saw, right? The U.S., Europe, Japan, all hit stock records overnight. That is thanks to, of course, NVIDIA. HS Tech, though, is on the back foot here as we open the gates. We're about 0.7% to the downside here today. CSI 300, though, there you go. We are Shanghai looking a little bit better than Hong Kong here this morning. Hang Seng, we're down about 0.4%. We're watching Commodities in particular, you're seeing Shanghai crude as well as iron ore and Dalian up some 1% here this morning. So commodities are catching a bid. The small caps, the CSI 1000, also doing quite well here today at the get-go. It's not a broad-based rally, though. It's been a mixed picture. If you take a look at what's really driving this, Macau gaming is down about 0.7%. Developers are flat. Financials, industrials are catching a slight bid here this morning. But we're watching and waiting, of course, those property numbers, which could be happening any second now. It certainly is one to watch, right? Because the HSCEI is actually one of the best, or is the best performing benchmark month to date this month.
Not a line we're perhaps expecting to hear at the start of February, but we actually do just have those new home prices coming out, and we've seen a drop of 0.37% for new home prices on the month. That's for the period of January, so a little bit better than the month prior because it was a contraction of nearly 0.5%. Still, though, it is just pointing to further weakness, and we know the property market in China, it's not just facing very deep-seated damage to buyer confidence. There's also those structural challenges that the industry needs to contend with in terms of demand and supply. Used home prices as well. This is actually the first time we believe this is being reported here, but used home prices, we're as well seeing those drop nearly 0.7% on the month. That's again for the period of January, although actually it must have been reported prior because the prior reading was down 0.8%, but still in context here, or looking at that in aggregate, it's just further weakness we're seeing in China's property sector.
Yep, I believe when it comes to new home prices, that is the 8th straight month where we have seen prices actually in contraction. So that certainly continues to be that story, that trend there. As you say, right, used home prices. I mean, this is one where we actually are seeing existing home sales are actually picking up more than we're seeing in new home prices. That was some of the new data that we got in the last couple of days or so during that Spring Festival holiday. But certainly, we're seeing a little bit of movement across these property stocks, but not a whole lot here today. We're still tracking, of course, the tech space, AI, autos, the like here today. So NVIDIA, whether we see day 2 of this, we're certainly seeing that in some of these Taiwanese suppliers, some of the AI stocks. There you go, Baidu, we're up 1%. Interesting note from Citron Research here overnight. They were talking more about the ADRs, but they're saying Baidu remains the most underappreciated name in AI, which is quite interesting. They're saying when it comes to the ADRs, it could hit $200. We're watching some of these other AI stocks. iFly Tech, though, is slightly lower here today. Some pretty not too good car sales numbers coming through for February, down close to 16% year on year. So we're watching the auto space very closely. BYD down some 1%. Let's bring in David Wong, Senior Investment Strategist for Equities at AllianceBernstein. He joins us here in our Hong Kong studios. David, it's good to see you, and Happy New Year.
Happy New Year.
It's time to turn bullish on China, you say. Why?
Absolutely. We think that there's a lot to like about the China story today. I mean, for one thing, we actually have been tracking sentiment indicators on China, and it's actually at an absolute extreme. It's so negative that it's really time to be bullish. When we see sentiment this bad, we've generally made money in the China market over past cycles. When we look at overseas positioning in China, it's actually lower than it was before MSCI started including China in its benchmarks. So this is the worst positioning we've seen amongst foreign investors in 10 years. And when we see all of these things and the fact that there's actually positive year-over-year earnings growth last year and this year, we actually think there's a lot of different ways to win. We can build a portfolio that is going to be, in our view, worth more at the end of the year than at the beginning.
Firstly, what's going to be in the portfolio? And secondly, again, you mentioned earnings, you mentioned sentiment, but what else is making China so attractive to you?
Well, we just think that when a market's been down for 3.5 years and there's just been widespread capitulation, there are a lot of opportunities for us to find ideas that have literally become the babies thrown out with the bathwater. We look at the industrial space, which you were citing earlier, and there are great companies making buses and trucks that export to the rest of the world, and they are actually seeing very robust revenue and earnings growth trends. And you know, we understand why people are concerned about macro. It's definitely got its weak spots. You were talking about property sales earlier, but actually, when we look at existing home sales volumes, just as an example, we're actually still seeing very decent transaction volumes. And we just think what is happening is that this trend of China kind of overbuilding with new homes is coming back down to earth. But that doesn't mean that everything is falling apart in China. We do think that the Chinese New Year retail sales numbers that we've started to see on a preliminary basis look very encouraging.
Yeah.
And there's a lot of parts of the Chinese economy that are doing okay.
We've been here before, David, and obviously we've looked at whether it's been the worst when it comes to investor positioning. But, what are you seeing in terms of positioning? Is it really just momentum trading, tactical opportunities that people are doing, or is it really real money coming back to this market?
We are seeing definite flows for the last 3 or 4 weeks. There's actually been a bid for Chinese equities. And if you look across global EM, actually China has been even more popular than India recently, just because there is starting to be contrarian money coming back to the market. And we need to just remember, when things have been this bad for this long, you have a very low bar to clear when you just want to do less bad, which is what any first stage of a market rally is based on.
I was reading your notes earlier and you said in Asia, follow the ROE. Why are you saying that for Asia specifically?
Well, we do think that Asian investors have always been a little bit gun shy of U.S. equities, actually, because of valuation. And one chart I could just kind of talk you through that I showed to them is if you put price to book on the y-axis and return on equity on the x-axis, you can just draw a line straight up from the zero bound up that will reach U.S. and U.S. tech. Global markets are efficient, and Asia has underperformed because its ROE has lagged the rest of the world. But what we are very encouraged by is that markets from Japan to Korea and potentially other places in Asia are starting to really focus on return on equity and on shareholder return. When we see what the Korean government, for instance, announces a week from now, we expect to see trends that are already in place in terms of shareholder return policies being strengthened in Japan, for instance. And we do think that is actually a very encouraging sign for the rest of Asia. We're really far away now from the China beta trade of 2 decades ago. But what we can actually expect is that if on a bottom-up basis, companies improve their corporate governance and start returning more to shareholders and getting rid of kind of long-term passion projects, that is going to be good for Asian markets.
Is there any market that you see in this region that could outperform the U.S. this year, though? I mean, this is a market that continues to beat, and I'm guessing with the NVIDIA earnings, I mean, we're continuing to edge through these all-time highs here right now.
Sure. The U.S. should still have pride of place in any investor's portfolio. But we do think that, there's a difference between asset allocation and what you want to do tactically in 2024. And when we look across markets today, the U.S. will benefit from a broadening beyond the Mag 7 story of last year. But, when we look at Asia, there's so many companies that have delivered earnings growth last year and will continue to this year, and that are actually way cheaper than anything that you can buy in the U.S. today. And so we just think having some mix of Asian and U.S. stocks is going to be of benefit to many investors.
Right. David, thanks very much for your time this morning. That was David Wong there, Senior Investment Strategist, Equities at AllianceBernstein. And just recapping those China property numbers that came out a few minutes ago. At a headline level, yes, we still saw it in contraction territory for used home prices, new home prices as well. But the other key takeaway is that the drop was a little bit slower than the reading that we had coming through for December. So the numbers, new home prices down around 0.4% on the month. The month prior was 4.5%, that contraction. Used home prices as well down around 0.7%. Again, that drop slower than December, but still weakness coming through across the property space. So really that focus on the property sector, those support measures, and actually we've seen China property stocks one of the biggest gainers over the course of this week. On that expectation, though, it's about further support.
It's actually gained that gauge, I think, every day except for Monday. So, you continue to see property stocks are certainly in focus here today. Let's talk a little bit more about part of that property story is, of course, the consumption space. And what we're seeing with the slowdown in China is really taking down some of its rising consumer startup stars. And they have been hyped as the country's replacement for brands like Coca-Cola and Haagen-Dazs. But now let's see what the outlook is. Let's bring in our global business reporter, Jinshan Heng, on what you're seeing across some of these startups in China.
Yeah, actually, I think a few years ago, the narrative was still like Chinese consumers are turning more and more premium products. They are also turning to their domestic brands because of the pride in national companies. But now the fortune for these startups from Chi Forest to Chime Ice Cream has really changed because of the investment pullout as well as the slowdown in consumer demand. So what we saw is aggregate capital raised in this field for consumer goods in China has shrunk 93% from its peak of 2018. At that time, it was more than 70 billion a year raised in this sector. But now it's so small, so that a lot of these startups are facing both funding problems as well as consumer demand issues. So we are seeing shops closing down. We are seeing companies not meeting their sales target. We're also seeing them pricing lower and lower in order to compete, not only with their local rivals that are downgrading their prices, but also with these foreign companies that are launching products that are similar to what's popular in their demand in China.
So that shift in sentiment, that weakness that's coming through for this sector, do you really think that that's something that's permanent?
Yeah. So what we saw from the Lunar New Year travel demand, we can see that people are out and about again. However, if you look at the per person spending, they are still much lower than pre-COVID. So what we are seeing is it seems like the sector is becoming busier again, but in terms of getting people to really put money out of their pocket and be willing to buy the same product they were willing to pay for a few years ago, that seems like a long way to go for the companies that were startup. And with the funding shrinking, it's harder for us to see new brands coming up. In one time, it was so easy for us to capture a few companies that's very new and exciting, but now that sector is just not as trending anymore.
Yeah, what would it take for the venture capital to come back then?
Yeah, I think definitely that was one idea when we were talking the last segment, whether China is cheap enough for them to re-enter. However, now there's not only the demand issue, but also geopolitics with the US, with Australia, with Western Europe for the funding to come back to China. So that's definitely a question remaining to be asked.
All right, Jinshan, that was our Bloomberg global business reporter, Jinshan Hong there. And we've just heading into the session here, 15 minutes into trading so far, and we are seeing that move for the upside. But a bit of a talking point, the Shanghai Composite hitting 3,000, that level for the first time since December. So it is that strength that's actually coming back into Chinese equities, so extending that rally really over the course of this week. That CSI 300, you can see there at the top of the screen.
All right, we are seeing continued optimism when it comes to, of course, NVIDIA. Is this really the Taylor Swift moment, as Dan Ives says, when it comes to some of these tech bulls out there? You're certainly seeing that, right? That is actually spilling over to the rest of Asia for a second day. Taiwan Semi's up. We got SK Hynix up close to 4% in Seoul. SMIC also 2% higher. Nasdaq futures, though, are flat this morning. TSMC. Let's talk more about that. Will officially open its Kumamoto fabrication facility in Japan this Saturday, with mass production to start later this year. It's an early victory for Tokyo in its race to make more chips as governments around the world work to boost domestic semiconductor capabilities. In an exclusive interview, Hisashi Kanazashi, IT Industry Division Director of Japan's Ministry of Economy, Trade and Industry, tells us what's prompted Japan's move.
Of course, Kumamoto TSMC's fab is very significant for Japan because, the fab is kind of to fill a gap between supply and demand in Japan. So without investment from TSMC, we only have over 40 nanometer technology node in Japan. But, recently the demand for less than 40 nano is getting traction in Japan by, like Japanese car industry or other, robotics industry, etc. So that's why the supply capacity from Kumamoto TSMC first fab from 28 to 12 is kind of essential to the Japanese, industrial activities.
We've reported that the numbers could be $20 to $30 billion. It could go as high as $67 billion in terms of financial support for the chip industry. What would you say to the taxpayers of Japan who are going to help build this industry? Why is it worth it?
I think, Japanese public people already realize the importance of the support for semi-industry. So what we are doing is to tell the importance of each project to the public people, of course. So the kind of economic security perspective is one of the element, and the other is economic kind of a ripple effect perspective. As an example, TSMC project is expected to have the large scale of the economic, spillover effect. So actually, we already have watched semi-related, companies, many, semi-related companies are moving into the Kumamoto prefecture, where TSMC is, actually constructing their first fab. So which cause, of course, investment, spillover effect, as well as, create job creation as well. And also, considering the salary level or payment level from TSMC, it is higher than the of course standard level of Japanese companies. So which can make a very positive impact in terms of the raising salary level as well in Japan.
It seems like Japan has jumped out to an early lead in this effort to build the domestic chip industry. The United States is trying to do similar things.
Yeah.
Europe is trying to do certain things also. What are the reasons that Japan was able to do this so quickly?
Actually, considering the past, what we have, thought is, everybody thought Japan is too small, too slow in terms of the financial support. We sincerely regret that misdemeanor for the past. So that's why we realize the importance of speed. I have served, a couple of ministers of METI, so everybody told me that speed is very important to attract the investment from our side.
That was Hisashi Kanazashi, the IT Industry Division Director of Japan's Ministry of Economy, Trade and Industry, speaking exclusively with Bloomberg's Peter Elstrom in Tokyo. And we're heading through the morning session so far and taking a look at how stocks are faring. And it is that broader move here we've got to the upside, really being supported overnight, of course, by that stellar run and that rise in Nvidia continuing to climb, adding $277 billion in market cap. But broadly, it's IT stocks that are leading the gains so far. Shanghai Comp there to note at the bottom of your screen because it earlier just crossed that 3,000 mark.
All right, some big stories we're tracking for you around the world today. Shares of Houston-based startup Intuitive Machines are up after their lander touched down on the moon. It's the first time a U.S.-made spacecraft has made it there in one piece since 1972. It's also the first private spacecraft to land on the lunar surface intact. It's hoped the landing will provide an up-close look at the moon's South Pole region and offer NASA new information about the lunar planet. Now, the U.S. and China are set to be discussing new measures to prevent a wave of EM sovereign defaults. Our sources say steps being considered include extending repayment times and increasing financing from the World Bank and other multilateral lenders. The talks aim to ease developing countries' debt burden, amounting to more than $400 billion, and is one of the biggest attempts at economic cooperation between the U.S. and China in years. Meanwhile, leaked documents from Shanghai-based cybersecurity vendor iSoon appear to outline the broad scope of China's state-sponsored cyber attacks on foreign governments. The files, seen as authentic by industry experts, appear to show successful attacks in 2021 and 2022. Targets include the UK Foreign Office, the Royal Thai Army, and NATO Secretary General Jens Stoltenberg. And continuing on in geopolitics, China's going to renew its panda diplomacy efforts with the U.S. and other nations after spending recent years bringing the bears it loans to foreign zoos back home. China's Wildlife Agency recently reached an agreement with the San Diego Zoo and the Madrid Zoo in Spain. The move marks Beijing's latest efforts to improve relations with the West. So you could be seeing those cubs as soon as the summer, I believe, in San Diego. They're working towards bringing them back to Washington as well as Austria as well. So
yeah, that's right. A few different places you're going to be able to see the pandas.
At least the pandas are
back. All right, quick check on how we're going with markets so far. Maoyan is one to note. That's the entertainment giant. Absolutely pretty big surge here, but the story is that they've reported strong preliminary profits, so pretty good signal, I guess. We did see better numbers coming through for the box office in China over the Lunar New Year break. Not the same story we're seeing in the EV space there, though, because we're seeing car sales slumping, given that holiday lull, and drivers still awaiting rebates as well. So we are seeing a bit of weakness coming through. China property to note, better numbers than the month prior in the latest results.